Netflix is down over 35%. And a lot of you guys are asking, is now the time to start loading up on Netflix? So that's what we're going to cover on this channel. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys, and welcome back to the channel where the goal here is to help 1,000 people achieve financial independence much sooner. And jumping right into the news, it's of no surprise to any of you guys that Netflix closed down over 35%, wiping more than $50 billion off of its market cap. And of course, one of the funds that was most impacted from this was Pershing Square, which is led by Bill Ackman, as they acquired more than 3 million shares in January. And you can see here that their position loss was about $400 million, which is approximately the same amount of money that my wife spends on Netflix after they've raised their prices 17,000 times this year. And so you can see that they sold their position because they said that they lost confidence in their ability to predict the company's future prospects. And so look, I don't mean to throw any shade here, but my question is, if you purchased these shares in January, how would you really be able to predict the future prospects for Netflix in light of the fact that a lot of companies are getting really good at subscription streaming, and companies like Disney have been giving it away? But nevertheless, these guys are a lot smarter than I am, so I'm not going to try and throw shade here. And Bill Ackman said the loss on the investment weighed on Pershing returns for the year by 4 percentage points, and Pershing's funds are down 2% for the year, which makes sense because Netflix lost almost 2/3 of its value this year. And the thing that I find most concerning about the news is that Netflix and all of these types of companies are largely unpredictable because you don't really know how they're going to compete against competition in an environment where customers are switching subscription providers. And what I'm trying to say with all of this is that it's super hard to predict which direction this is going, especially with the rise of connected TV and connected TV type advertising, which you're seeing on Roku. So you really don't know what the business model is going to play out to be, but I don't know how to forecast this. And I don't know how Pershing Square forecasted it. Well, I guess they didn't forecast it because now they're admitting that they were wrong. So who knows? But as far as I'm concerned, it was always out of my circle of competence. But here's something even crazier now. Netflix is exploring with a version with ads. And that's even nuttier to me because what it really says is that now Netflix is going to compete with a host load of other companies that do just this, which is movies with advertising. And I'll show you a couple of them. So if you go on your Roku app, you can see right here, you'll get Tubi that comes up, which is free movies and TVs. Well, it's only free because they serve you ads. There's Plex, which is also free movies and TV. And there's FilmRise. And these are just the first three that came up on the home screen. So what I'm trying to say is that Netflix is going to try and compete in a space that's crowded with other people. Now, Netflix might have the larger name recognition, so that's fine. But I think what they're going to end up doing is they're going to have two levels of content. So the less attractive content that they have is probably going to be the stuff that's ad supported, and the more premium stuff that they have is probably going to be subscription based. I think this goes a long way into eroding what Netflix actually is, because I don't know if you guys have watched movies with ads lately. You don't have that skip feature like you do with YouTube ads. So it's a little aggravating because you have to actually sit there through 4 minutes of ads. I don't know how well that's going to work. Now, with that said, I think the market sort of has digested that. You can see here that the next 12 months consensus PE is 21 times earnings. So the market has heavily discounted this company, which makes a lot of sense. Now you guys love when I tell you guys these old stories. So I'm going to tell you a little bit of a story of when I first started valuing Netflix. So the story begins with a comedian. His name is Joe Rogan. I'm sure you guys have heard all about Joe Rogan in the news lately. I used to listen to his podcast years ago, but I'm just too busy now. But that being said, you can see here with this arrow, Joe Rogan actually released a stand-up special on Netflix around the 2006-2007 timeframe. At the same time, Netflix offered me a free 1-month subscription. And so, of course, I subscribed for the 1 month. But that being said, by being in Canada, I was actually new to Netflix. At this time, I was still walking over to Blockbuster and physically renting movies. So this was new to me, but I immediately looked at the stock of Netflix. And the thing that stood out to me, we are in 2005, 2006, maybe 2007 at this point. We're in an environment where we just went through Napster. We now are in the Google video type world. I don't think YouTube was available just yet. And we also have LimeWire for any movie that we want to download. So it was a really interesting time where I'm thinking, why would someone pay for Netflix when you can just download any piece of media that you want using LimeWire? Well, the answer to that is that there's a lot of people who don't want to do that. Especially back then, your internet service provider would send you a letter and saying, stop downloading movies and stuff. So I understand why people would want to do it. And plus, also, when the legal option is available, people are going to use the legal option. I get it. It just wasn't for me. However, if the competitive advantage was just that it was legal, then you don't really have a competitive advantage other than the fact that you're first, because there's going to be other people that jump into this space, which we're now seeing. I was just very late on when I thought that the competitors would come in. Netflix kind of owned this space for a long time, but now you're seeing Disney come in. I think Universal's coming in as well. Amazon Prime is in this space. So it's now starting to get crowded. And so I don't know how you maintain any sort of competitive advantage unless you're going to focus on content. And content is the one area where it's really difficult to maintain any form of competitive advantage because you never know when your competitors are going to have a hit. So I think it's a really risky business model overall, which is why I don't even track Netflix on our tracker. That being said, I do want to point out something to you. At the same time that I was looking at Netflix, there was one company that everybody in Canada was investing in. And it might just be because I'm around that Kitchener-Waterloo area, but there was a small company out here in Kitchener-Waterloo area that had a huge product. What was that? Well, you can see here, it was BlackBerry, and everybody was investing in that product. And the one question I had for people at around 2006 was, what is BlackBerry's main source of revenue going to be 25 years from now? And nobody had an answer for me. And I was told that I was dumb for even asking that question because BlackBerry's moat at the time was the business community. I personally argued that their moat wasn't the fact that they're in with the business community. I argued that their moat was the fact that they had a keyboard on their phones. Now, how long until other phone providers start putting a keyboard on their phones? Or better yet, how long until people start being able to use screen keyboards much easier than they currently were? And of course, you guys know what ended up happening. Around 2010, I think, the iPhone launched and it changed the game. Everyone went to keyboardless. And of course, you can see what happened to BlackBerry stock. So the question I ask is, what major competitive advantage does Netflix have 25 years from now? And I don't see a major competitive advantage from content, and I don't see a major competitive advantage from just being an online provider. I think they keep a lot of the market, but I don't think they have any major competitive advantage. So that's a reason why I can't invest in the company. I can't see that far ahead. I don't understand. I don't know what's going to happen here. And so that's why I was really surprised with Perishing Square saying that they were able to forecast out the future in January. And then, of course, they weren't able to forecast it just now. And of course, for those of you who are not familiar, what I'm really saying when I'm talking about competitive advantages are economic moat. And so you can see here, an economic moat is the ability to maintain competitive advantages over its competitors in order to protect its long-term profits and market share from competing firms. I don't think Netflix does any of that. And so moving on, I want to point out some of the most popular stocks. If you're a YouTuber and you cover these stocks that Jim Cramer is talking about, your channel is going to grow much faster than any other channel. And so that's actually one of the reasons why my channel hasn't grown as fast, because I haven't been focusing on sort of like the trending names, because I saw a lot of risk in these names, especially last year. And so I was quiet on them for a reason. But if you just go through this list, you can see Netflix, barely a competitive advantage, maybe first mover, that's it. Peloton, I can throw an iPad onto a bicycle. PayPal, lots of competition. Square, lots of competition. Zoom, maybe a small competitive advantage there. I do like Zoom. I think that they're going to own that space with Microsoft, but it's a low-level competitive advantage at best. Tesla, I'm just not smart enough to understand Tesla, but I actually think Tesla ends up having a competitive advantage with their AI, but I'm not smart enough to understand that. The one name that I do like on this list is Roku. I think Roku does not care who wins in the streaming space. They are not competing on content. They are competing on distribution. They have their apps installed in many TVs And if you really want, you can just pick up a Roku player. And people aren't going to switch away from their Roku players once they have them. Look, people are going to have Apple TVs. People are going to have Amazon Fire Sticks or whatever. But I think Roku's the clear winner in that space. And the beauty of it is because they don't care who wins, they can cut deals with all these content providers to allow people to subscribe to those streaming services like Netflix, like Disney, through the Roku app, and then they can take a cut from that. Plus, they can make money on the emerging business, which is the connected TV, the advertisements through those free movies. They take a cut on all of that as well. Now, you can see here that I actually model Roku, and the Patreons are actually able to get access to this model. But you can see here that I'm not really forecasting Roku's revenues to grow as fast as they currently have. So from 2022 to 2024, I'm saying that it grows at 25% a year. Thereafter, it's growing at 15, and thereafter, it's growing at 10. I almost guarantee that Roku's probably going to grow faster than that, but I just want to show you the rate at which they have been growing. Over the last 4 years, you can see that they've been growing at around 50% a year. So for me to forecast 25% a year growth, that's really pessimistic in my opinion. That being said, look at what it means for the valuation. So on a 20 times valuation multiple, which I also think is low, I think it probably should be around 25, the company is currently trading at what I think is its fair market value using pessimistic growth assumptions. So if you're extremely bullish on Roku, now might be the time to consider purchasing it. I really want this at 50% of that valuation because, once again, I really like those deep discount opportunities. I'm willing to wait for it to drop another 50%, but I'm going to track it patiently and just wait. And you can see how long I've been tracking this. So I actually valued Roku as one of the first companies that the Patreons had access to. I valued it around May when it was trading at $400 a share. So we've just been watching it come down from $400 a share to under $100 a share, and we're just patient. I said that it was around $40, $50, which is where I wanted to get in at. Happy to wait. If it never comes, it never comes. I don't care. Now, what's interesting, however, is when you look at the cash secured puts, you can see the January 19, 2024s at the $55 strike price. It's actually yielding 11.5%. That shows you how pessimistic the options market is on this. Imagine generating 11.5% on anything else where the share price is so far out of the money. So I think there's a realistic chance that this comes down. Now, would I sell a cash secured put at $45 a share if I can catch a 15% yield on it? Probably I would. Maybe I'd wait for that yield to go up to like 25%, but I would be really interested in thinking about something like that. And I want to give you a little bit more about why I like Roku. So this is the tracker that the Patreons get access to. And so you can see that the name Roku is here. The current share price is $97 a share. Intrinsic value is $99 a share. Right next to that, I want to show you how there's other metrics that I look at. The first thing I consider is, does the company have debt? Well, Roku has no debt. Is the company inflation resistant? I believe Roku is. Does the company have a strong economic moat? Or like, what's the size of their moat? I think Roku has a very strong economic moat. The other thing that the Patreons can see is how much has the share price moved in the last week, the last month, and the last year. So you can see that Roku dropped 10% in the last week. It dropped 22% in the last month, and it dropped 72% in the last year. So very easily you can log right into this, which is just a Google Sheet, so you can have it on your browser, click right into it, and automatically in real time you can get access to all this data. And then of course, finally, the last thing that they get access to is you can see that they have the cash secured put analysis tool. So if you want to price out some puts, just throw in the strike price, throw in the put exercise price, throw in the premium, and you can see here the net purchase price is $44. The simple put yield is 20%, but the annualized put yield is 11.5%. So that's what I previously quoted to you guys. And of course, you can get access to all of that at the $5 a month Patreon level. So I highly encourage you guys to join us. There's a lot of value here. And once again, if you don't like it, within the first month, message me through the Patreon app. Say it wasn't for me. I'll refund all your money. Now, that being said, guys, one important thing that I've done and I want you to pay close attention to is I've doubled down on Alibaba. Finally, it's been a year before I made any transactions with the name. And in order for you to get an understanding of exactly how I did it, click right here.